Okay. Good morning, everyone. So today is 9th April. We'll start today's webinar. So today we'll give company updates on Ezion, and also we will talk about the updated trading note on Facebook, as well as the Phillip Recession checker. Lastly, we will talk about our Phillip 20 portfolio updates. Okay, firstly, we'll talk about Ezion's briefing held last week. So the management held the analyst briefing last week to summarize the refinancing and restructuring plan over the past 6 months. Ever since it was hot, it halted the trading since October. So firstly, the refinancing plan involved in several stakeholders, including the secure lenders, securities holders, the unsecured lenders, as well as the shareholders. So firstly, we'll talk about the resolutions for the unsecured lenders. It is mainly involve the banks, the 6 banks. So the total refinance amount was about 1.5 billion US dollars. So basically, these 6 banks agreed that they will extend the maturity to 6 years for the existing loans, and meanwhile Ezion will be charged at a lower interest rate, which is the LIBOR plus the cost of funds from the banks. Meanwhile, the banks will also extend further support with additional loans up to 180 million US dollars. And for these loans, they are exclusively only for the purpose to fund the working capital. That means Ezion cannot use this extended loan to pay out dividend, to buy new assets, or do any business that is not related to the existing operation of the current assets. The next is the resolutions for the security holders. So these are involved in those bond and note holders. The total refinance amount was around 575 million Sing dollars, and the maturity of this pool will be extended by 6 to 10 years. And for these note holders, they agree on the 0.25% of the interest rate, and they also agree to lift all the covenants. So there are 2 options for the bondholders. As the management mentioned, close to 80% of the holders opted for the convertible bonds, which accrued amount was around 453 million Sing dollars. And the conversion price will be reset every 6 months. That means after the starting date will be effective on the day it resumes trading. The next is the resolutions for the unsecured lenders. The amount of this part was quite minimal, which was amounted to 18 million US dollars. And Ezion will issue several warrants to the lenders for them to convert the outstanding loans to equity. And also these lenders will will receive a lower interest rate. Sorry, and these lenders will charge lower interest rate on the loans to Ezion, and the conversion price will be reset every 6 months. So lastly is the resolutions for the shareholders, and Ezion will issue 3 warrants for every 5 shares with the exercise period of 5 years. It is worth noting that the exercise for these warrants will not be reset. So what will be the impact of this whole plan? The most importantly, the shares will be diluted from the current of 2 billion shares to 6.6 billion shares. As you can see the table here. And also the current net gearing ratio is about 4.5 times, which is not sustainable for the whole company to maintain its operations moving forward. So according to the management, they think that the net gearing will be gradually lower in the next 6 years on the conditions of 4 assumptions. So the first assumption is that all these bonds will be fully converted, and the next is the current charter rates will remain at a flat level. The next is there will not be more units deployed within this 6 years time, and lastly there will be no more capital injection. However, last Friday Ezion announced that the PhillipCapital will inject new capitals into Ezion, and PhillipCapital is the sub-fund of Temasek, which means Ezion succeeded in partner with or seeking new strategic investors. So we see this is a positive signal for Ezion, because this is a sort of the endorsement from the a reputable investor. So moving forward, we expect the group can find more investors to pull more capital into the company to fund the further operation. And the next is the cost savings. Based on the plan, if review, there will be like $30 million of savings from the bank loans per annum, and also there will be $28 million of savings from the securities per annum. So how do we see this for Ezion? This is a 6 years runway for Ezion, because right now it has resolved the debt burden as of now. So moving forward, it can refocus more on the normal operation and the lowering of the gearing ratio. So the management disclosed that they see the recovery or rebound of the sector this year. The management sees the demand from the wind farm on the east and south coast in China, and also because right now is the Malaysia's re-election. So the management thinks that after the election, the oil and gas sector in Malaysia will have another big recovery. So this table shows the current fleet size of the group. As you can see that the utilization rate for the jackup rigs and OSVs are quite low. So moving forward, the company will continue to focus on the deployment of the lift boats, and they will also consider to dispose of some jackup rigs and OSV, or to convert part of these two types of assets into MOPU. It is expected that Ezion will resume trading on 16 April, which is around one week from now. So next I will pass on to Conway to talk about the trading note on Facebook.
Thanks, Gonzo. Okay, so last week we published a trading note for Facebook. As of last done, I think the trading thesis for Facebook is still valid, so we're here to present about that. So we released a trading note for Facebook with an entry price of 159.79. The last done is about 157.20. With target price of $220 a share with a stop loss of 139. The Bloomberg consensus analyst target price is about 220.60. So I don't believe I need to do much introduction about Facebook. So we'll just do a bit of company highlights. So just to get you up to speed about Facebook's business model, 98% of their revenue is earned through advertising. So far they've been doing very well with revenue growing more than 50% for 5 consecutive years. Besides that, Facebook also has 25.7% of the market share for global internet advertising revenue. It's second highest after Google. And Facebook, as of their latest earnings results, they reported that they have 1.4 billion active users daily and 2.13 monthly active users. So recent price action wise, they peaked at about $193 before dropping slightly after their results. The drop in the results was due to concerns about drop in user time and user engagement with the platform. But since then, they actually recovered slightly before the news about the Cambridge Analytica came out, which sent the price tumbling to lows of about 152 USD. So our investment rationale is that we believe that while the news cycle is bad, the potential fallout and damage to Facebook's intrinsic value has been blown out of proportion, and that the current situation represents a buying opportunity. So we'll go into why we believe that Facebook still has a very high intrinsic value compared to despite what the recent news cycle is. So first, we touched on it just now that Facebook has a massive user base. It has 140 billion daily active users and 2.13 billion monthly active users. You can see in the slide below that the advertising revenue is about 39.94 billion USD. Like I mentioned, out of their 40 plus billion, about 98% is advertising revenue. If you were to look at the average revenue per user in US and Canada, that comes out about 26.26. Europe is 8.71, Asia Pac is about 2.52, and other users, meaning like Africa, etc., is about 1.85. So you can see there's a big discrepancy between US, Canada, and the rest of the world, and so we believe that that Facebook still has quite a bit of runway to grow as they continue to monetize, to increase the amount that they are able to monetize the users from the other countries. You can see later in my slides, there will be charts that show you the growth rate at which they are able to increase the revenue per user so far, and that we believe that as the rest of the countries become more and more affluent, that there will be significant runway for them to monetize these users. So you can see here the geographical breakdown when it comes to the monthly active users for Facebook. And you can see that Asia Pac has actually been growing quite significantly. And like I mentioned, if you compare Asia Pac to US, I think they're only monetizing at about 10% rate. And as your Asia Pac growth continues to become more and more affluent and more developed, I believe there's a significant runway for them to increase that monetization and increase the amount of revenue they get from them. Here you can see the daily active users, same as the previous, except in daily. You can see that since 2015, they've been able to maintain as a percentage of their daily users out of the monthly users, maintain at about 66%. So 66% of their monthly users are daily users of Facebook. Here you can see what Facebook reported for their average revenue per user. You can see that in the year of 2017, they've managed to grow for the US and Canada part quite significantly, as well as a year-on-year for the fourth quarter from $19.81 per user in US and Canada to 26.76. As I mentioned, Asia Pac has also been growing quite significantly, year on year from 2.07 to 2.54. So you can see it's less than 10% of the average spend for US and Canada users. So I believe that there's still quite a significant amount of growth that they can come up when Facebook is able to. I mean, as the Asia Pac continues to become more and more affluent and become more and more developed, that advertisers will want to start paying more to reach to this group of people. So besides the massive user base and the ability to monetize that massive user base, we believe that digital advertising as a whole is also set to continue to grow. So in 2017, you can see in this slide, the digital advertising spending came up to about a total of $209 billion. That's 41% of all media spending. 2017 TV advertising was $178 billion, 35% of all media spending. So last year, 2017, was actually the first year in which digital advertising spending actually overtook traditional media in terms of TV advertising. I believe that this trend is set to continue to happen, that advertisers are going to continue spending more and more on online and digital marketing rather than through traditional media through your TV advertising. Consensus analyst estimates that the digital ad spend is expected to reach USD 375 billion by 2021. That's more than 50% increase in the next 3 years. You can see in the graphic below, Facebook is out of all the global internet advertising spending, Facebook is 25.7%, Google is 61.38%. See, they are second place by quite a large margin. So Facebook's market share was 25.7% in 2017. Back in 2016, it was 20% and 17% in 2015. So you can see they've been able to grow their market share quite significantly, taking share away from, I think, Google and Alphabet. So even if we assume that Facebook maintains a 25.7% and they don't grow their market share even more, 25.7% of that 375 billion is about 96.5 billion, which is more than double their current revenue in terms of how much they are earning by 2021. That would give them a 4-year CAGR of 24%, which, while it's lower than the 50% their past 5 years, I think by the law of large numbers, it's not reasonable to expect them to continue to grow at a 50% rate indefinitely. But 24% is still very respectable, and I think it's still quite a very good growth rate. So the recent dip in price, I think, has brought Facebook to very low valuations. I think they've been quite undervalued compared to their historical. So if you look at their PE ratios compared to their 4-year average PE ratio, it's 18.95 compared to their 4-year average about 53.64. Again, given a 4-year CAGR of 24%, I think a PE ratio of 18.95 is quite low for this US growth stock. The total revenue for FY17, as mentioned, was USD 40.65. They've had a 5-year growth rate of 50.75 so far. in terms of free cash flow, they grew at, they managed to generate 17.48 billion in free cash flow for FY17, and that's up from 11.62 billion in FY16 and 7.8 billion in FY15. So you can see they've been able to quite significantly grow their free cash flows, and I think that's because of the next two figures you can see in this slide, their gross margin, their net margin. So gross margin wise, they have a very, very impressive 87.58% in FY17. That's up from 86.29, 84.01 in the previous 2 years. And their net margin is also very, very high at 39.2% in FY17 compared to 36.97 and 20.57 in the previous 2 years. So in terms of their margins, they're actually in a very low margin, actually in a very high margin business. They're able to generate a lot of revenue, and out of that revenue they're able to generate a lot of profit from that. So let's talk about the elephant in the room, which is the Cambridge Analytica. So if you've been in the news cycle, at least for Facebook, for the past couple of weeks, you'll be quite aware of this Cambridge Analytica situation. But just in case there's anybody who still doesn't know what's happening, Cambridge Analytica was a political analytics group, and they had previously offered money or some other form of incentives in order to get permission to access a certain number of users' database from Facebook. But by virtue of the way that Facebook operates, they were able to access data from other friends of these initial users and other connections from these initial users and use their data, get access to their data. So previously it was first reported about 50 million, but now I think the figure stands at about 87 million people's data. Data was not really breached but accessed because there was no hacking actually involved. I think by virtue of the way Facebook and all other social media works, if you're a friend of another user, then you'll be able to see things like their pictures, their postings, etc., etc. And it's just the way that social media works. I mean, don't think you'll be able to create a social media page in which someone, if you have access to someone's data account, you can block that person's access to a friend's account. It's just not the way social media works. So I don't believe that it is something that can easily be legislated away. But anyway, even if we take a look historically, you'll see companies with significant data breaches have not really suffered very permanent damage in terms of their share price. When you look at Equifax, which was one of the biggest data breaches last year, they had 145 million people's data stolen in 2017. And mind you, this is stolen. It's not like the Cambridge Analytica where it's there was no actual hacking. This was an actual hacking in which the security was breached and the data was actually stolen. That caused the share price to drop from a peak of $142 down to $92, which has since recovered to about 117.81 US dollars. So, give me a second. Presenting. The share price has since recovered to 117.81 US dollars. So we believe that it's unlikely that the government will impose legislation that will severely impair Facebook's ability to conduct its business. It's unlikely, even if they do pass legislation, that they will affect only Facebook. It's likely to affect all other social media and big data companies. And this is so we don't believe that it is in the government's best interest to impose these legislations that will impair and hamper this big data and social media industry. The reputation damage is likely to be the more risky damage to Facebook, but we also believe it's unlikely to be permanent either, due to the fact that there's a lack of alternatives of the size, scope, and features of Facebook. I mean, if you were to compare in terms of, let's say, LinkedIn or Twitter or Snapchat, these are all social media platforms that I believe is unable to compete with the size and the features of Facebook itself. And if you were to talk about the reputational risk in terms of like the boycott or delete Facebook movement that happened in the wake of this Cambridge Analytica news that came about, I think one of the famous examples was Elon Musk, the chief executive of SpaceX and Tesla, who was very famously reporting that he's deleting his Facebook accounts for SpaceX and Tesla, but he still left the page as well as his own personal account active on Instagram, which, if you're not sure, you're not aware, it's owned by Facebook as well. So you can see, even though he made a big hoo-ha about deleting his Facebook pages, he still left it open on Instagram, because in the end, we are living in a social media age, and it is very impossible for someone to be, I think, completely, for majority of the world, to be completely off social media. If you look at in terms of the poll in Canada, you can see that only 4% of users were willing to delete their Facebook accounts. But even those who were intending to delete their accounts, they were pretty much inactive anyway. 25% of them only use Facebook once a week or less. And I believe that this is also a very big thing only in the US, and that majority of people in, let's say, Asia have not really been affected or really care very much about this Cambridge Analytica issue when it comes to Facebook. So I'll pass the time now to Jeremy, who will talk a little bit about technicals for Facebook.
Thanks, Kangwei. So Jeremy speaking here. So we'll just briefly take a look at the chart perspective of what Facebook is showing right now. So on the screen, you can see right now this is the Facebook chart on a weekly time frame. So it's something that's more of a longer term perspective. So ultimately, you can see even with the 23% sell-off since its all-time high at around 196, even with that sharp drawn out 23%, all in all, I think Facebook trends still remain to the upside. As you can see over there, a markup some point in the charts demarcated higher high and higher lows. And even with that sharp sell-off, you can see Facebook is still kind of forming this series of higher highs and higher lows. And what we see right now is definitely this 23% sell-off is more of a correction. And probably it's trying to form the next higher low point for this particular long-term uptrend. And what we are seeing right now is probably the 149 recent low that we saw some 2 weeks ago could very well be the next higher low point for this particular uptrend. And the reason behind is because you can see there's a strong support that is kind of overhanging right now within the market. So one support being the psychological number of 150. So you can see as soon as the Facebook kind of fell below the 150 psychological round number, there was strong buying that came into the market and kind of rejected price and showing some bullish reversal candlestick pattern 2 weeks ago. And there is also another support that is kind of hanging over the market, which is a 50% retracement number. So this particular 50% Fibonacci retracement level was being drawn from this particular upswing from somewhere December of 2016 to the high somewhere in January of this year. And what we get is this particular 50% Fibonacci retracement level, which pretty much coincides with the psychological round number of 150. So all in all, there's a strong support that is kind of forming up right now from Facebook's perspective. And with the bullish price action that we saw 2 weeks ago, this particular hammer bullish price action, rejection of this strong confluence of support at 150 as well as the 50% Fibonacci retracement level, we think that the Facebook is kind of ready to rebound back into the uptrend and probably to retest the next resistance, which is at 169, followed by 190. And even after that hammer, you can see there wasn't really a follow through per se last week. But nonetheless, price still kind of a bob in between the particular hammer that happened 2 weeks ago. So all in all, I think for the bullish momentum to kind of take off, we first need to see Facebook kind of taking out the high of this hammer at around 163 or so. So structure-wise, long-term uptrend remains intact, and current price action suggests that there might be a reversal that's about to happen soon to take price back to the 169 resistance area next, followed by 190. Next, I'll pass back on to Kangwei to sum up Facebook.
Okay, so in summary, we are bullish on Facebook because of their massive user data, their massive user base. The fact that Asia as well as other countries' monetization rate compared to the US is so low, and makes us believe that there's still significant headway to be made for Facebook. We believe that the digital advertising is only going to continue to grow, and that Facebook's market share of this digital advertising is also set to grow along with it, which means there's still also significant runway for them to grow, and that their valuations right now, due to the price drop, is compared to historical much lower, and that represents a undervalued situation. So again, we reiterate a buy call on Facebook with an entry price we previously entered at 159.79. The last done price is 157.20, stop loss of 139, and a target price of 220. So with that, I'll pass the time back to Jeremy again, who will talk about the recession tracker.
Thank you. So let's get back to the US market. So I will just highlight some of the main kind of thing that happened in the month of March, at least from our recession tracker point of view. And what we see is at least volatility continues to remain on a hindsight after the volatility explosion incident that we saw in February. Even in March, volatility continues to remain high, which is why we are currently kind of seeing some crack signs showing up from some of the recession tracker in this particular slide. So for those that haven't been following the monthly recession tracker, basically we created this list of recession indicator, basically 15 of them, to kind of pinpoint exactly when the market might actually top over from the US side of things. So we segregated the indicators into two baskets, market-based data as well as the economic-based data. And right now, there are quite a few crack signs that has been showing up in the market-based data, which is yet to be confirmed in the economic-based data. So just to highlight some of the crack signs that's been showing up, the VIX index, the TED spread, the 210 spread, and more importantly, the price action in the S&P 500 are all showing some early crack signs that things are kind of weakening. But as of now, you can see the economic-based data right now, at least the most recent data that we saw for these few indicators, they are all more or less in green, which means they are still improving in comparison to the prior month. So economic-based data continues to remain at multi-year extremes, which is still a good sign that the economy is still pretty robust. And as of now, there is only one indicator that is kind of a flashing red in terms of confirming the bearish signal, which is the VIX index. So as a whole, in summary, only one of 15 indicators is kind of a flashing red yet, which is something that we wouldn't really be so affirmative about calling for the bear market. Probably we need to see more data within the recession tracker to kind of trigger its bearish signal for us to call for the bearish market, which is why we are kind of still risk on in the general equity market in the US. I'll just highlight more in depth with what I just mentioned, the crack signs within the market-based data in the following few slides. So the very one that you're looking right now in the screen is the TED spread. So we mentioned this quite a bit last month where we talk about how the TED spread has actually broke above its 2-month range of this 36 basis point somewhere around in February. And what's interesting is you can see since we broke out above this particular 2-month range, the TED spread continues to kind of move within this upward trajectory in a very steep manner. So last month, in the month of February, the TED spread was only trading at 41 basis point. And with one more month passed, it has actually spiked to a new high of around 63 basis point, which is quite a big move from the TED spread perspective. So again, for those that don't know what the TED spread is, basically measuring the spread between the 3-month LIBOR to the 3-month Treasury T-bill yield. And basically, in layman terms, when the TED spread is spiking, it's actually signaling distress in the interbank level, that there's higher borrowing costs within the interbank level. And right now you can see there's actually a huge seismic shift in terms of the trend wise. So for the whole of 2017, you can see TED spread basically trades somewhere below the 36 basis point area. And only somewhere around, like I mentioned, in February of this year, we suddenly see a spike in the TED spread, bringing us from around 36 basis point to a high of around 63 basis point. So currently it's still showing some sort of early warning crack signs here in the TED spread. But from our study, we see that the key threshold that kind of signals the bearish narrative, at least from the TED spread perspective, is the 1% level. So until we hit this 1% level in the TED spread, we remain bullish, at least on the long-term perspective for the equity market. And we just take this as the early warning signal that things are changing. And moving on to the next one, the VIX index, kind of still staying elevated. So like I mentioned again, somewhere in February, that was when we saw the VIX explosion incident when the VIX index hit a high of 50, which presented to us our first anomaly spikes in the market. So prior to that, the VIX index has been trading pretty complacently below somewhere around the 10th floor for the whole of 2017, again showing over complacency. And somewhere around in February, we saw the anomaly spike in the VIX index where it actually spiked up more than 100% in a single day. So that presented us this particular anomaly spike, and from our study, it seems like the VIX index is right now setting up a new panic floor at 13. So prior to that, like I mentioned, euphoria floor, it has been trading around that 10th floor for the whole of 2017. And for us to kind of get a sensing that we are moving into a period of more sustained panic, the VIX index needs to trade away from the 10 euphoria floor. And what we see right now is, with benefit of hindsight, this 13 level somewhere around in mid-March seems to be the new panic floor for the VIX index. And for us to get further confirmation that the market is really structurally weak, it has to actually go through some form of anomaly spikes again, probably spike above 30 for another 2 more occasions before we kind of get the sensing that the market is ready to turn over. As of now, it's not really showing up. And in fact, the VIX index still trades pretty tamely in a manner below 25 for the whole of March, which is kind of a decent from our perspective, until we see anomaly spikes above the 30 range. So continue to watch this space, because this will be pretty important in setting the tone in terms of the market staying on a risk on or risk off mode. As of now, it's still not really triggering the subsequent anomaly spike, which is why we are still kind of staying on the bullish side of things for the equity market. Crack sign number 3, 210 spread. I've also shown this quite often. So basically, 210 spread measures the slope of the U curve, whether we are in a steepening shape, flattening shape, or inversion curve of the U curve. And what we see here is, you can see the 210 spread continues to flatten in the month of March. And interestingly, at the end of February last month, the 210 spread was trading at a high of around 49 basis points. And with March gone, we actually kind of erased off another 10 basis points in the 210 spread, which is quite a big move from the market's perspective. And that is definitely happening in the background with the Fed hiking its interest rate in March this year. So in March, we saw the Fed funds rate being raised from 1.5% to 1.75%, which as a result, the 210 spread continues to flatten along with it. So just to illustrate how to read this chart, the 210 spread is the one at the top panel. The blue line at the bottom panel is the Fed funds rate. And as you can see over here, at the rate hike cycle, every rate hike cycle in history actually lead to the inversion of the yield curve eventually. So you can see over here, somewhere in 1988, this particular rate hike cycle caused the 210 spread to invert from a high of around 150 basis point to below 0, and actually hit a low of around negative 50 basis point. And the same one here during a dot-com period, whereby we saw the inversion of the yield curve being caused by this particular rate hike cycle, as well as the housing boom period, whereby this rate hike cycle of 1.5% to a high of around 5.25% subsequently in 2005 led to this inversion of the yield curve. So with no surprise, definitely the one that we saw, the current rate hike cycle began in December of this 2015. And since then, interest rate has been lifted from 0.25% to 1.75%. And as you can see, as a result, the 210 spread continues to flatten along with it, mainly due to the fact whereby the short end of the yield curve is way more sensitive than the long end of the yield curve, which means when we get a rate hike, what happens is the 2-year treasury yield will kind of move higher and faster as compared to the 10-year treasury yield, and as a result, it will continue to flatten. So with the Fed's projection, they are seeing at least 2 more rate hikes this year that will bring the Fed funds rate to 2.25%. And we believe as long as the Fed continues to hike its interest rate to stay in this rate hike trajectory, it will just be a matter of time before the 210 spread actually falls below the danger zone of 0 line. And when that happens, you can see historically when the 210 spread falls below the 0 line and goes into the inversion kind of a U curve, recession is not too far away. Recession being highlighted by the vertical highlighted strips over here. So historically, it's been happening with that kind of strong accuracy in terms of predicting a recession, and we believe this time around will be no different. So our study shows that at least using extrapolation based off the slope during this period, as well as the slope for the current flattening period, it gives us a range of around 8 to 9 months of further flattening before we see the 210 spread heading into the this danger 0 zone. So 8 more months will bring us to somewhere around end of this year. And we also did a quick study on the term premium that is being added on to the 2-year Treasury yield. And historically, at least since the start of the rate hike cycle that began 2015, on average, the term premium above the Fed funds rate for the 2-year Treasury yield is around 35 basis points, which means what is required for the 2-10 spread to actually invert is when we get a Fed funds rate of around 2.5%. So 2.5% being the Fed funds rate, once we include the term premium to the 2-year Treasury yield of around 35 basis points, that will bring the 2-year Treasury yield to around 2.85%. And usually when we get the rate hike cycle, the 10-year Treasury yield hardly moves with the Fed funds rate. So assuming that the 10-year Treasury remains flat at the current level of 2.79%, when the Fed funds rate is at 2.5%, that is when we more or less will get the inversion of the yield curve from a mathematical point of view. So all in all, you can see as of now, market is pricing in at only 2 more rate hikes this year. So if we get 2 more rate hikes this year and get 1 more rate hike in Q1 of 2019, somewhere in Q1 of 2019 is when we will get the Fed funds rate at 2.5%. And based off that, probably Q1 of 2019 is when we might see the inversion of the yield curve, which is pretty similar to what is being estimated by the slope of this particular flattening trajectory over here, which suggests that the flattening of the yield curve might come somewhere around end of this year. So keep a close lookout end of this year as well as Q1 of 2019 might very well be the point where we see the inversion of the yield curve. And then subsequently, with an average lag time of around 50 weeks or so before the recession kind of kicks in. So as of now, there might be still some further runway for the equity market to go moving forward until the end of this year, at least from the 2-10 spread perspective. But nonetheless, it's definitely showing some crack signs that's been kind of a flattening for the past month. Interestingly, price action wise, it's also showing some huge crack signs. So here's the S&P 500 index on a quarterly time frame. So this pans back very far to 1993 and shows you very nicely what the long-term trend is showing. So interestingly, probably I'll just run through how we read this chart. So on average, how do we kind of mark up the end of the equity bull market, at least during your .com and your GFC period, is after we see a period of blow-off phase, which means consecutive bullish quarter at a very steep pace. Usually the end of the equity market is being highlighted by 2 bearish quarters. So you can see over here, this highlighted area shows you 2 bearish quarters before the start of the bear market, where it took down the S&P 500 index by 45%. This is the .com period, as well as the housing boom period, whereby we saw 6 quarters of consecutive bullish quarter during the blow-off phase, and ultimately 2 bearish quarters over here in this highlighted area to kind of pinpoint the end of the equity bull market, where we subsequently saw a 46% sell-off in the S&P 500 index. So we could very well be seeing a similar replay here, whereby somewhere around in 2015, that was when we kickstarted this blow-off phase. So kind of a crazy 9 consecutive quarters of bullish gains, and only this quarter, as of March, we finally got our first bearish quarter after some 9 consecutive bullish quarter. So this might very well be the first crack sign that's been showing up, at least in terms of price action perspective. Even though on a quarterly perspective, it's only down around, I think, 2% or so, but nonetheless, it's still a bearish quarter. So for us to kind of get a sensing if the top is in, at least from a quarterly time frame perspective, is if we do actually get another bearish quarter next quarter, in June of 2018, that might very well be the time we might see a top in the S&P 500 index. So keep a close lookout for the dividing line, which is the closing price of March, and that is 2,640 points for the S&P 500 index. So in June, at the end of June, if we do actually close below 2,640, then we could more or less get another bearish quarter, which could signal the end of the equity bull market. But however, if we do actually close back above the 2,640 points opening price of the Q1, Q2, we could actually see the equity bull market being extended. So 2,640 point will determine whether we continue to see the equity market, bull market continues, or we are seeing the start of a bearish phase. And even on a monthly time frame perspective, it's also showing some crack signs. So crack signs being highlighted by, at least on the RSI perspective, it's showing up right now. So somewhere, I think in January of 2018, the RSI hit an extreme high of 88. And usually when we get a RSI reading above 70, it usually signals irrational exuberance. And for us to kind of confirm that the RSI is going through a period of mean reversion, it has to actually close below the 70 overbought region. So historically, it's been kind of true that way when we get the RSI heading into an overbought territory and subsequently closing back below the 70 overbought region. S&P 500 index is ready to go into a mean reversion, and which is what we got in March, where the RSI closed somewhere around 68, which is below the 70 overbought region. So that is the first crack sign that we observe, at least on the RSI perspective. But more importantly, we can't just plainly use the RSI to kind of pinpoint the top of the equity market. Overlaying at the top panel over here is the price action on the S&P 500 index on the monthly time frame, and the red line over there shows you the 10-month moving average. And what we see is combining two of them, 10-month moving average together with the RSI, what is needed to kind of pinpoint the top within the equity bull market is the mean reversion in the RSI, as well as price closing below the 10-month moving average. So this point over here is when we get the confirmation of the 2 points that I just mentioned, the price closing below the 10-month moving average, as well as the RSI confirming the mean reversion. Once we get that, it's more or less the end of the equity bull market, and we saw 45% sell-off during this period. And a similar replay happened somewhere around here in late 2007. So right now we are getting only the first signal in the RSI kind of confirming a mean reversion, but ultimately the 10-month moving average is still kind of desperately holding price up. So you can see for the past 3 months, prices tag the 10-month moving average and subsequently rejects it. So you can see there is a huge significance here in terms of how the 10-month moving average is kind of propping price up. And key level right now, 10-month moving average is at 2,618 points. So on a monthly perspective, as long as the S&P 500 index continues to stay above the 2,618 point, we believe the equity bull market should still continue to remain intact. But however, if it does actually close below the 2,618 points 10-month moving average, things might actually be changing from a strong bull market into one that might be weakening and probably seeing a start of the bearish market. So all in all, you can see in terms of price action wise, the monthly time frame is showing some crack signs. Like I just mentioned, the quarterly time frame is also showing some crack signs. And in terms of reference point wise, 2,618 is the reference point for the monthly time frame, and 2,640 points is the reference points for the quarterly time frame perspective. So all in all, if we actually get a bearish close below this 10-month moving average signal at 2,618 point, we believe it will just be a matter of time before the quarterly time frame also confirms this 2,640 bearish quarter. So keep a close lookout because when one of them confirms its move, we should get affirmative view from the S&P quarterly time frame signal as well. But all in all, right now it's still remaining strong, even though there might be some early crack signs showing up. Moving on to some positive data, like I mentioned, the past few slides that I've just shown are all the market-based data that are showing only some early crack signs. But on the economic front, the economic-based data are all kind of remaining in the robust kind of a territory at multi-decade extremes. And just to highlight one here, UMich consumer sentiment. At the bottom panel over here, you can see despite the trade war scare that we saw in March, this data actually factors into the trade war scare. And as you can see, with the trade war scare, at least consumer sentiment perspective still remains high. And we saw the UMich consumer sentiment kind of taking up to a new highest level since 2004 at 101.4. And ultimately, as of now, sentiment as a whole across all three surveyors from Conference Board, from Bloomberg, as well as from UMich, remains at the high side, and we are still not really seeing some scare from the consumer's perspective. And ultimately, for us to get a full confirmation that the market is really turned around, we need the economic-based data to actually confirm that reversal as well. So now it's not showing up. For that to play out, the UMich consumer sentiment needs to at least break below this multi-year uptrend line in order for us to kind of see sustained weakness within the market. Another good economic-based data that is showing up, ISM manufacturing PMI, basically sentiment on the industrial side. Even though we see the data kind of edging off its high of 60.8 to 59.3 in March, you can see the manufacturing PMI remains at the multi-year high over here, which is still pretty remarkable, per se. So all in all, most of the economic data are still showing this kind of a growth, either at multi-decade high or multi-decade low, such as your unemployment rate. So last Friday, we got the unemployment rate number as well, coming out at 4.1%, staying flat at the multi-year low. So unemployment claims are still strong as well, and retail sales numbers are still strong. So all in all, right now, we are only seeing some early crack signs within the market-based data, which might be too premature to call for the start of the bearish market. And right now, the economic-based data are still right now in a kind of a rosy side of things. So until we get a full confirmation of the economic-based data confirming the market-based data, we continue to remain bullish on the equity market. And in terms of price action wise, more so in the near term, what we see is right now the key level that is holding price up is the 200-day moving average. This green line over here is the 200-day moving average, and it spans across the 3 US major indices, the Dow Jones Industrial Average, the S&P 500 Index, as well as the S&P 500. Their respective 200-day moving average is right now kind of a desperately propping price up. And just to show you the relevance and the importance of the 200-day moving average. So this 12% sell-off is the sell-off that's being caused by the VIX explosion incident that happened somewhere in early February. And you can see even with that sharp sell-off, the 200-day moving average managed to kind of prop price up, not just once but twice, and subsequently reverse price back up into this particular uptrend. And right now, this particular sell-off is mainly caused by the steel and aluminum tariff that's been announced by US in early part of March. This is the top that's being formed by the particular news flow. And subsequently, we saw the S&P 500 index kind of a shedding of around 7%. But with the 200-day moving average kind of coming in and saving the day again, you can see since touching the 200-day moving average, the S&P 500 index has been consolidating around that level for around the past 2 to 3 weeks. And just to top things up, you can see there is actually another uptrend line that I've drawn. So the initial point that I've drawn for this particular reference uptrend line is the Brexit low. And the second connecting point over here is the VIX explosion low over here. And subsequently, you can see right now it's cutting through price, kind of a propping price up again. So in terms of support-wise, there is 3 confluence of support that's holding price up. A psychological round number at 2,600 points, 200-day moving average, as well as a long-term uptrend line that I've just drawn. So all in all right now, support is holding up pretty well. And we believe this uptrend, at least in the short-term, near-term perspective, is holding up fine. And more importantly, what we see is in terms of price action, there is a strong bullish price action that happened somewhere around in mid of last week. This particular hammer that formed up kind of confirms that price might be forming a near-term bottom, and we might be seeing a reversal back up in the trend in the S&P 500 index. And probably the target for the S&P 500 index moving forward will be the 2,800 points, followed by 2,878 points for the S&P 500 index. And just to highlight again some quick note on the Dow. So same price action for the Dow, 200-day moving average propping price up since the VIX explosion incident, as well as the recent sell-off caused by the tariff scare. So again, there is a bullish price action that kind of happened in the midweek of last week. And we believe price action-wise near-term, Dow is also signaling reversal soon to the upside, back to the all-time high of maybe 26,000. And last but not least, Nasdaq 100 as well, 200-day moving average propping price up once again. And again, same thing over here, the bullish price action that we kind of observed happening last week might actually form this particular low at 6,300 point as the next higher low point for the Nasdaq 100. So in summary, for the US side of things, despite seeing some early crack signs showing up in the VIX index, the TED spread, the 210 spread, as well as the price action, we still continue to see the recession tracker kind of remaining fine as a whole. And ultimately, until we see further deterioration from the economic-based data triggering their respective threshold, we remain bullish on the general equity market. And with the current bullish price action of the 200-day moving average in the 3 major US indices, we do actually believe that we might be seeing a near-term rebound soon for the US equity market to bring us back into a risk-on mode that we haven't been seeing for the past 2 months. Yeah, with that, I'll move on to the Phillip 20 portfolio, the monthly review for March. So before we dive into the performance of the Phillip 20 portfolio, we'll just take a quick look at the STI. So STI wise has been kind of following the movement from the US market pretty tick for tick in terms of performance wise. And what we saw is definitely in the month of March, US was down and it dragged down the Singapore market down with it at negative 2.56% for the month of March. Again, mainly because of the risk-off sentiment caused by the trade war tariff talks that has been happening between US and China. But nonetheless, with the 2.56% sell-off, in terms of price action-wise, the STI is still pretty nicely in this particular uptrend since December of 2016. Continue to form this series of higher highs and higher lows, at least from a longer-term perspective. But more importantly, instead of the 200-day moving average, like I just mentioned in the US side of things, that is kind of providing a floor on price. For the STI, the key level right now is this 3354 to 3341 support area. So it was first formed somewhere around in July of 2017. And since then, this resistance has become support for 3 more occasions. So this highlighted region is the support area that I just mentioned, the 3354 to 3341 support area. And you can see since September of last year, this level has been popping price up and kind of halting the sell-off that we have seen. And even the most recent sell-off that we saw last week, there was strong bullish price action that came to the market again that halted the sell-off at around the 3354 to 3340 support area. And more importantly, in terms of price action wise, we are seeing a strong bullish reversal candlestick pattern forming up last week. So this is a weekly time frame chart. So at the end of last week, we saw this hammer kind of forming itself as it rejects the strong support area. This by itself is a bullish kind of a signal that is being signaled to the market that we believe the STI is ready to kind of reverse back into the uptrend and kind of retesting the 3549 resistance area followed by 3600 points. So in terms of STI wise, I think it will depend heavily on the US market, whether we do see the risk on coming back into the market or not. And like I just mentioned, at least on a recession tracker point of view, we still believe the longer term picture for the US market still has further runway to run for the equity market to head higher for at least another 8 more months before we see the economic data kind of triggering its bearish threshold. So 8 more months of upside in the longer term perspective from the US side should kind of spell to a higher risk on environment to the rest of the market, including the Singapore market. And in terms of price action wise, right now it's showing some strong reversal to the upside for the STI. So all in all, price action and economic based data as well as the recession tracker are still showing pretty decent risk on kind of environment moving forward. So just some quick snapshot of what happened in March, at least for the Phillip 20 portfolio. 2 trades were closed. FNM was closed out with a 0% PNL, kind of hitting our break-even price at $2.22, and we hit stop loss for Wing Tai at around $2.06 with a 9% drawdown. And with the month of March, we entered 3 new trades. So we entered into Genting, Chris Energy, and UOL at this respective price. And this is the current gain and loss as of last Friday. So money performance wise for the Phillip 20 portfolio, we were down around negative 0.83% as compared to the STR of negative 2.56%. And in terms of total return wise, Phillip 20 portfolio since inception is up only around 3% as compared to the STR of around 8%. And here is just some of the watch lists that we are currently monitoring to kind of add on onto our Phillip 20 portfolio watch list that is mainly based off our technical model. And here is just the snapshot of the Phillip 20 portfolio holdings as of last month. So with that, we've come to the end of today's webinar. We will pause right now for questions if there is any. Thank you.
This is Guangzi here. There is a question asking about the fair trading price on Ezion after its resumption of trading on 16 April. As of now, we don't have any recommendation for the trading price, but for the outlook, we think that it has gotten through the debt issues at this point of time. That means moving forward, it will start to focus more on the restructuring of its existing assets. As of now, it started to it already succeeded in pooling some capital from the reputable strategic investors. So the next, we believe that it will continue to seek for more capital injection to fund the business. So we think that the downside for Ezion is limited. However, we think that it will take longer than expected time for it to normalize its business and bring back the good profitability. So we think the price will be quite flat for in the near term. Thanks.
Hi, if there's no further questions, we will end today's webinar. Thank you for joining us today. I will see you guys next week. Do remember to check out our stocksbnb.com for more reports, as well as to you can see all the other archive webinar videos at that site. Thank you.